Hello traders, and welcome back to Explain the Charts. Today is October 21st, 2025, and we are taking a deep dive into one of the world's most traded currency pairs, the EURUSD. We'll start by breaking down the current news and macroeconomic environment before moving into a detailed analysis of the charts. The current narrative is complex, with several major forces pulling the market in different directions. A dominant theme remains the diverging monetary policies between the European Central Bank and the U.S. Federal Reserve, with traders keenly watching inflation data for clues on future rate adjustments. Recent reports from Forex Crunch suggest a neutral to moderately bullish outlook for the euro, citing easing political tensions in France after PM Sébastien Lecornu survived two no-confidence votes. This has provided some temporary stability for the euro. However, this is counterbalanced by a weaker U.S. dollar, which is feeling pressure from lower U.S. Treasury yields, with the 10-year falling below 4%. Bank of America has even maintained a bearish bias on the dollar. But we also have the persistent risk of revived U.S.-China trade war fears, which could trigger safe haven demand for the dollar and put a ceiling on any euro rally. Upcoming economic data, particularly PMI readings from both the US and Europe, along with US CPI data, will be critical in shaping the market's next move. So, with that fundamental backdrop, let's turn to the charts to see how this is all playing out. Here on the daily chart, we can see the bigger picture. After a strong uptrend that peaked in mid-September around the 1.1920 level, the pair has entered a clear and decisive downtrend. We are seeing a classic pattern of lower highs and lower lows, which is a hallmark of a bearish trend. The price saw a significant drop in early October, falling from above 1.17 to below 1.16. This lines up with the news reports of the euro struggling at that time. There was a relief rally last week, which corresponds with the news of easing political tensions in France. However, this rally appears to have failed right at a critical resistance zone between 1.1700 and 1.1730. The rejection from this level has been sharp, with the last two trading days showing significant selling pressure. Today's candle so far is decidedly bearish, pushing price further down and confirming that sellers are currently in control of this market. To get a better look at this recent reversal, let's zoom in on the daily chart, focusing on the price action since the beginning of September. Here you can clearly see the peak we made on September 17th, followed by the first leg down. Notice the bounce that started around October 10th, which looked promising for bulls. But the key takeaway is the failure to make a new high. The rally was stopped dead in its tracks right at that 1.1720 area, which acted as support back in early July and has now flipped to become strong resistance. This failure is a significant bearish signal and suggests the downtrend is likely to continue. The aggressive selling we've seen since October 17th confirms this bearish reversal and has now broken below the support of the recent pullback. This price action tells us that the market participants who bought during the rally are now likely under pressure. Now let's switch to the 15-minute chart to analyze the most recent intraday action from the last couple of trading sessions. Here we can see the anatomy of the reversal in greater detail. On October 16th, you can see the price trying multiple times to push above the 1.17 level but failing, forming a clear area of distribution where sellers were absorbing buying pressure. Then, as we move into the 17th, the floor gives way. We see a series of strong, impulsive bearish candles, indicating that sellers have taken firm control of the short-term trend. The price cascades downwards, breaking through several minor support levels without much hesitation. Throughout October 20th, the price has been consolidating at these lower levels, mostly trading below 1.1650. Any attempts to rally have been weak and quickly sold into, reinforcing the bearish sentiment we observed on the daily chart. This short-term view confirms that momentum is firmly to the downside as we head into the next session. Okay, let's pull back to the daily chart to consolidate everything we've discussed and formulate some potential scenarios. Based on the price action, the bearish case currently holds a higher probability. The trend is down, momentum is bearish, and we have a confirmed failure at a key resistance level. The immediate price level to watch is the recent low around 1.1636. A convincing break below this level would likely open the door for a test of the major psychological support at 1.1600. If sellers manage to push through 1.1600, our next major targets to the downside would be the support levels identified in the market analysis, around 1.1500 and then potentially 1.1380. This scenario would be reinforced by stronger than expected U.S. data or an escalation in geopolitical tensions that favors the dollar. Now, for the bullish case to play out, we need to see a significant change in character. Buyers would need to absorb all the current selling pressure and stage a decisive rally back above the 1.1720 resistance zone. A daily close above this level would invalidate the current lower high structure and could signal a potential trend reversal. Such a move would likely require a strong fundamental catalyst, like very weak U.S. CPI data, which would increase expectations for Fed rate cuts. If buyers can clear 1.1720, the next upside target would be the 1.1800 level. It's also possible we enter a period of consolidation, with price chopping between 1.1600 and 1.1720 as the market waits for the next major news driver. So, to quickly recap the key price levels to watch. Our major resistance is at 1.1720, followed by January 1800. Our key support levels are at the psychological 1.1600 level, followed by 1.1500 and 1.1380. Given the current evidence, the path of least resistance appears to be to the downside. I would assign roughly a 65% probability to a test of the 1.1600 support level in the near future. A bullish reversal feels less likely for now, perhaps around a 35% probability, and is contingent on a firm break above 1.1720. The main things to watch for are the upcoming PMI and CPI data releases, as well as any major statements from the ECB or the Fed. Finally, it's crucial to remember that this video is for informational and educational purposes only and should not be considered financial advice. The Forex market is highly volatile, and you should always conduct your own research and consult with a qualified financial advisor before making any investment decisions. Trade responsibly, and we'll see you in the next video.